Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing Spirit AeroSystems stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Spirit AeroSystems is based in Wichita, Kansas. It is the world's largest aerostructure manufacturer. The company builds several important pieces of the Boeing aircraft, including the fuselage of the 737 and 787, also the cockpit section of the fuselage of nearly all of its aircraft. Spirit also produces fuselage sections and a front wing for the Airbus 350. The company was formed when Boeing sold its Wichita division to investment firm Onyx. In 2014, Onyx sold all of its shares of Spirit. Over the course of the 9-year investment, it received $3.2 billion on a $375 million investment. Let's get started with the model. This is a mid-cap company, 4.7 billion market cap. They're trading at $44 a share, and they have 106 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So the company had positive and growing free cash flow until 2020. It became negative. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they also have positive net income every year except in 2020. Revenue is a sales for the company. That peaked in 2019 at $7.9 billion, but was cut in half in 2020 to $3.4 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. Example, cost of the airplane parts. Then the difference between those two numbers is their gross profit. And they did have negative gross profit in 2020 due to low sales. It was over $1 billion in 2018 and 2019. Then below that is operating expenses. Examples are depreciation, marketing, and insurance. Then below that is operating income, and they had negative in 2020. Below that is the interest they pay in their debt, and that was nearly $200 million in 2020, much more than prior years. Below that is other income and expenses. This is usually impairments or other non-operational gains and losses. Then below that is pre-tax income, then their taxes. The company reports gains and losses from its equity interest. Earnings from equity interest are non-cash items. These are the gains and losses from its investment in other companies. The bottom line of the income statement is their net income, and they have a big negative in 2020, and it was positive in prior years. This is the company statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. If Spirit purchases a warehouse to manufacture airplane products, the entire cost of the warehouse goes into CapEx the first year they buy it, and then it's depreciated over time onto the income statement. Operating cash flow minus CapEx gives you your free cash flow, and the company had negative free cash flow in 2020, but they did have positive in prior years. Since the company had positive operating cash flow, it looks like they were using that money to buy back stock. They bought back $500 million in 2017, then $800 million, then $76 million. When a company buys back stock, that decreases the shares outstanding, making your shares more valuable. They also use some of their free cash flow to pay a dividend, but their dividend payment was cut drastically in 2020. We'll talk more about the dividend a little later. It looks like the company's issuing debt to fund their business. They issued $1.3 billion in 2018, and they repaid $600 million that year. So they added about $700 million of debt in 2018. They added $1 billion in 2019 and added another billion in 2020. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow, you don't have much of a business. They were generating positive, healthy operating cash flow until COVID hit in 2020, and that became negative. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. To calculate operating cash flow, you start with net income, then you have to add or subtract the non-cash items on the income statement. They passed through a $278 million depreciation expense. That brought down their net income $278 million, but it doesn't affect cash flow, so we add it back here. $95 million deferred taxes, $24 million of stock-based compensation, and $19 million of other non-cash items. Even though they reported an $870 million loss, they actually lost $745 million of cash flow. Let's look at the capital structure. $900 million of equity, $4 billion of debt. They're 18% equity, 82% debt, so they're pretty leveraged. Their net debt is $2 billion. Net debt is total debt minus cash on the balance sheet. And their WACC is 8.88%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $10 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $8 billion. We divide that by 106 million shares. And we get a calculated stock price of $76. They're trading at $44, so they're trading at a 41% discount. It's a strong buy according to the model. Simply Wall Street values the company at $61. So I expect them to lose money in 2021 and then return a profit in 2022. Of course, anything can happen. They could return to profitability faster or it could take them longer. This is just my estimate based off of looking at their financials and also looking at other analyst estimates. This is a stock price the last 5 years. So you can see in 2016, it was going up a lot for about a year or two straight. Then it was pretty flat. And then it dropped in March like everything else, and it hasn't really come up too much. So the stock is trading at a nice discount relative to its pre-March highs. If air travel comes back this year or next year like it was in 2019, their stock price could get back up to $100 where it was before the March crash. They pay a really small dividend, 9 basis points, 0.09%. They pay 1 penny per share. They were paying 12 cents a share, but they cut their dividend in March. They might as well pay nothing. They have a high beta, 2.05, so the stock moves more than 2 times the market. The stock has gone down 21% in the past 52 weeks, much worse than the S&P 500, which went up 17% in the same time frame. And the 52-week low was 14, the high was 58, and the stock is trading above its 50-day and 200-day moving average. About 3 million shares are traded each day on this stock, and of the 106 million shares outstanding, 99 million are on float, 79% are held by institutions, and about 7% of the shares on float are shorted. If you invested $10,000 into this company 10 years ago, you would have more than tripled your money at one point, but if you're still holding on, you're at $17,000 today. That's a 5.7% annual return. The biggest shareholder is Vanguard at 8.5%, then Scopia, BlackRock, Sculptor, and State Street. Let's look at the financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. When a company has negative PE, you look to the price to sales ratio. Price to sales is stock price over sales per share. They're at 1.4. So investors are paying $1.40 for $1 revenue. That's a really good price to sales ratio. Price to book is stock price over book value per share. They're at 5.5. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have 857 million of equity, 76 million of tangible equity, because they have 780 million of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have a negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. they can easily cover their current liabilities with their current assets. And their current assets are $1.9 billion of cash, $900 million of receivables, and $1.4 billion of inventory. So the company does seem to be well capitalized. It did have negative free cash flow, but it has $2.8 billion of working capital and a $4 million dividend payment. So it has about $1.9 billion of funding. The best way to look at ratios to compare them to similar companies, I've done videos of 18 companies in the same industry as Spirit, and if Spirit has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE because they're negative. They're doing much better than average in price to sales and price to book. They're doing well in current ratio. They have a bad ROE. They do have a lot of debt. Their market cap is much smaller than average at $4.7 billion. Average is $37 billion. And they pay a really small dividend. So to summarize, I have them trading at a 41% discount. Air travel will always be around, so there's no risk of that going away. Things are a lot slower now due to COVID, and there may be some bankruptcies, but this company seems to be well capitalized. And they also do most of their work with Boeing, which is a massive company. So as long as Boeing is around, this company should be around. I ranked their free cash flow as 5 out of 10 because they had that big negative in 2020. I ranked their revenue 5 out of 10 because it dropped a lot in 2020. And I ranked their ratio as 3 out of 10 because of the negative PE, negative ROE, and the high debt. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.